And if you have any complaint, you can always get back to me. That's the purpose of the video. So I hope we have been watching the video. If you have anything to say about that, can you please in the chat box? Any challenge about the video, everybody? Any challenge about the video? Please let me see you chat. Now, if you can see the screen, I've started sharing the screen again because I started recording. Can you use the chat box and just tell me yes? Just type yes if you can see the screen now. IS 16. Yes, okay. Madam Obuna say yes. Rati say yes. Okay. Mr. David, can you see the screen from your hand? Can you see the screen from your hand? Okay, thank you very much. So we are looking at IS 16, property, plant, and equipment. Property, plant, and equipment. And please just 1 minute. 1 minute. Property, plant, and equipment. That's what the standard is all about. And the concept is so that we know how to treat items of PPE in the financial statement. How items of PPE is treated in financial. This standard is treated at the skills level and at the professional level, corporate reporting. Now, it's important for me to let us know that all the IFRS, that is all the international financial reporting standards that is established globally are treated both at skills level and at the professional level. The only difference is that the questions at the skills level may not be as technical as those at the professional level. But we're covering it both so that everybody will have a full understanding of what we are expected to do. And as time progresses, we'll be treating past questions on every standard we have treated. In this class, we have treated IS 8. That one was the first standard I treated. It was free. I didn't charge that time. I think only one of us in this class was in that class. However, if you have gone through the chart in this class, you'll see the video. The video on IAS 8, talking about accounting policies, changing accounting estimates, and errors. That's what that standard spoke to us about. Please, how many of us have watched that video? Mr. David, have you watched that video? If you have, just say yes. Have you watched the video on IS 8? Video on IS 8 is the last that I posted. The last that I posted, yes, that's okay. Dorothy, have you watched the video on IS 8? Video on IS 8, have you watched it? Okay, Mr. David is typing. I need to know if you have any challenge watching those videos and if it's clear. And the other one, IS 12, the video is also here. David is typing, so I'm waiting for him to send this message. In Dorothy, I'm also expecting your response. Okay, you're also typing. I need to know. Oh, you have not watched Dorothy. Yeah, okay, all you do is, but I don't have IS 12. IS 12 video is also there. You'll find it above, then you'll find the IS 8 below. In the post, the first one I worked on was IS 12. IS 12 was the one that was posted here first, and then even all the notes we use in IS 12, I posted them on the screen. It's still in the group chat. It's there at the first, then even both the audio and the videos are the ones I put there for IS 12. And go below, you see IS 8. Just that IS 12 video is not labeled IS 12. Okay. Madam Bimbo is also typing. Let me listen to what she has to say regarding that. I need to be catching up with you just to ensure that you follow up. Yes, she's trying to point to you, Mr. David. If you can see the chat screen, she's pointing to you that this is an S12 video. So we click on a chat, it will take you straight to that video so that after the class, you will be able to watch the video. That's the most important thing about the class. Okay, Dorothy and Mr. David are also typing. I'm seeing you as you type. I'm just waiting for a message. We need to clear this background so that we are on the same page. Okay, Dorothy says thanks. That's good. That says thank you. And Mr. David is typing. Let's wait for him. So it's important. The purpose, one of the advantage that this class has over the physical class. Okay, Mr. David also says thank you. So, Madam Bimbo, the two of them I say thank you to you for referring them. One of the benefits of this online class is that it keeps us up to date. You can always go back over the previous classes, sit down. So she says you are welcome to the both of you. You can always go back over the classes, sit down, and then you study them again. The notes, I put it there. Even this note this morning on IS16, I will put it there, and I will also put there the videos just for you to watch and watch and watch over again. One thing about video pictures is that when you are able to see a thing over and over again, when you are preparing for your examination and you are at the revision point, it will be easier for you to revise. And if you have any issue, you can always go to any class and raise the question. And I believe that after this diet, nobody will be writing this paper again. That is, nobody's going to have reference by God's grace. I wrote it once, and that's what prayers I always make for everybody. I can see you, Mr. Michael. You are welcome. Tosin, I can see you. You're welcome. Yes, I may not be able to hear your voice. You also can use the chat box to say and greet us. Okay. Tosin says thank you, sir. So that's it. So quickly, let's go on. IS16, property, plant, and equipment. So this standard tells us how we treat items of PPE in the financial statement. So we look at definitions, property, plant, and equipment. We say property, plant, and equipment are tangible items that, one, are held for use in the production or supply of goods or services for rental to others or for administrative purposes. So any items that are tangible and you are using them either to produce or to supply services, to supply goods, or you hold them to rent them to others, or you use them for administration, like the laptop you use in the office is PPE. The chair you sit on in the office falls under PPE. That fan that is blowing in your office is under PPE. The AC in the office is under PPE. All those items that belongs to the company and are tangible are treated under PPE. Some are so small that you may not want to take them so serious, like stapler, that's stapling machine, all those tiny, they are all aggregated and treated as PPE. If the company uses them in the process of rendering services or producing goods, they fall under property, plant, and equipment. They fall under property, plant, and equipment. Second, I said, I expected to be used during more than one period. That's another thing that establishes PPE. That is, you can use them for more than 1 year. You know, in accounting, when we say something is short term, that thing is 1 year. If we say it's long term, it's beyond 1 year. So if it's an item that can only be useful in 1 year and after 1 year it's no longer useful, it does not come under property, plant, and equipment. For it to come under property, plant, and equipment, it must be able to have more than 1 year useful life. And next to that, we're talking about how do we measure property, plant, and equipment initially. You see, when we are treating standard, all the IFRSs, when we are treating them, there are 4 things we are looking at under each standard. The first thing is talking about initial measurement, recognition. That is recognition of an item in the financial statement. The second one talks about measurement. When we talk about measurement, we're not talking about using tape rule to measure something. When we say measurement, we are talking about at what amount should anything that will be recognized in the financial statement be recognized. You know, recognition talks about the inclusion of an item in the financial statement, the inclusion of a transaction in the financial statement. And then measurements talk about if we are going to put any item in the financial statement, at what amount. You know, everything that accountant understand is naira and kobo. We can just understand how, then every other thing will fall into place. So if we are recognizing an item as an item of PPE, at what amount do we recognize that item? That's what measurements talk about. So we're talking about initial measurement. We say property, plant, and equipment are initially recorded in the accounts of a business at their cost. So for instance, you buy a motor vehicle, a company buys a motor vehicle for 3 million naira. That's a cost. We'll still be looking at the elements of cost, the things that make up the cost of an item. So they are initially recorded at their cost. And we look at the definition of cost. The cost is the amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributed to that asset when initially recognized in accordance with the specific requirements of other IFRSs. Now, that's what they say cost, the amount you pay or the fair value of the item, or if you are giving an item in exchange for another one, the fair value of that item or whatever. If that item we're talking about falls under any other standard, whatever the standard says about the cost is what make up the cost. So we say if payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the period of credit unless it is capitalized in accordance with IAS 23. Now, what they are saying is this: your company buys a car, for instance, for 3 million naira. For that car, you are going to pay for it in 1 year or 2 years' time. You are buying it on credit. Now, it does not matter whether the person is saying, okay, because you are buying on credit, you must pay 3.5. We are just saying, okay, the agreement you have had with this person is that I'm buying this car January 2023, but I'm going to be paying you February 2024. And the person says, okay, on that condition, you are going to be buying this car for 3 million naira. Now, that 3 million naira, that is what we call the element of cost. Inside it, that must be recognized on behalf of that vehicle in the financial statement. And there's another element in that same 3 million naira that is an interest element. We will see an example now of how to separate the interest element from the cost element from the whole amount of purchase. So let's look at this example one. We say a company buys a machine on 1 January 20X7. The terms of the purchase are that the company will pay 5 million naira for the machine on 31 December 20X7. You can see 1 year later. You buy in January, you are paying in December. They say an appropriate discount rate is 6%. Now, let me explain this appropriate discount rate. From our previous knowledge in the social sciences, you would have also known something about monetary policy, and that central bank is the one in charge of the regulations of the monetary policies. Now, central bank decides what we call the discount rate. That is the rate at which loans are given out in commercial banks. So the rate we are seeing an appropriate discount rate is 6%. This means that the monetary regulator of the country, if this is Nigeria, for instance, we say central bank or central bank of any other country, has decided that 6% is the rate at which bank must give out loan. The essence of this is that we are going to be separating the interest element from this 5 million, because they said the term of the purchase are that the company will pay 5 million for the machine on 31 December 20X7. That's when they want to pay. They bought it in 1st January, they're going to be paid at the end of the month. So that's what we call the time value of money. That money they are paying is not what they are going to be recognizing in the name of this machine. They are going to be recognizing the cost, and they are going to be recognizing what we call the interest element. So I will be opening my Excel sheet now, as usual, for those who have been in this class, for us to know what we call cost and what we are talking about the interest element, So quickly, let me open the Excel sheet for us to be able to deal with this issue. Let me open the Excel sheet for us to be able to deal with this issue. Let me share the entire screen so that when I switch, you'll be able to see. Now, if you can see the Excel sheet, just use the chat box and say yes. If you can see the Excel sheet that I just opened, you can see the Excel sheet. Let me see you say yes in the chat box. If you can see this Excel sheet, please type yes in the chat box. Can anyone see the Excel sheet? Okay, Tosin says yes. Okay. Yes, yes, that's Madam Bimbo says yes, Mr. Davis says yes, Rati, okay, yes, that's very good. Now, what we are going to be doing now is that we want to separate the cost and the interest element of this transaction. That's what we want to do. The entire money paid is 5 million. How much of this money should be recognized as the amount of this machine, and how much of it is interest, since it's going to be paid in 1 year after. So now there is a formula we use to calculate the present value of money. The formula for present value of money. So let me type it: present value of money. Present value of money. Now, the concept of present value of money emanates from the fact that 1,000 naira in your hand today has more value than 1,000 naira in your hand at the end of the year, 31st December. That is, I give you 1,000 naira this morning, or I promise to give you 1,000 naira. Now, it is better I give you the 1,000 naira today than for me to delay and give you the 1,000 naira in 31st December. Because by the time I give you that 1,000 naira today, it has more value in your hand than it will have if I give it to you at the end of the year. That's where the concept of present value of money emanates from. So, and it has its own formula. To calculate the present value of money, we say 1, you can see, divided by, then we open a bracket, we say 1 plus R, 1 plus R, then we close the bracket, and then we say raised to power n. Okay, let me see how I will do the raised to power in this place. Okay, just 1 minute. I'm trying to get this the figure right, just to know how I'll put it appropriate, so that you see the formula first. Or you can write it in your note, please. I'm trying to, because I'm not sure Excel cannot show raised to power formula for present value. 1, let me just say PV, present value, PV equals to 1, then under it, we open a bracket, 1 divided by 1 plus R, then we close the bracket, and we say raised to power n. Let me just put this somewhere. Excel is not not show me how to do raised to power. I would have used Word for you to see this formula. Top border. So let's just say this is what the present value of money is like. The formula for present value of money. Present value of money equals 1 over 1 plus R raised to power n. That n will be on top of this 1 plus R. That's the formula for present value of money. Let me see if I can just quickly download the formula for you to see, so that I'll just put it there on the screen. Present value formula. So please, you can see my screen. I'm trying to just download the picture so that you see what it looks like. And you can see, okay, there's something here. Let me just pick this thing. 1 minute. Snip into. And I want to cut down that formula so that I'll be able to put it in a place where everybody will see it. I'm going to put it where everybody will see it. Formula for present value of money. Present value of money. Now, let me just use this. Let me use this. We need to have that formula in our notes. I know some of us probably have had the knowledge in the past, but I don't want to assume anything. So that everybody will be able to see exactly what we are doing. So let me insert the formula here for us to see properly. Present value of money. The formula for discounting money to the present value. Insert picture, device, so that all of us will see exactly what we are talking about. This part is very important. We will be encountering it. We will be encountering this in several topics, as we progress in treating standard, so that everybody has this formula with them now. Now, I've tried to put it on the screen. Now, this FV, that is, they are talking about the value of money now. Usually, it will be 1 divided by, this I stands for interest, and that I, at the same time, means R. PV, that is the present value of money, equals to this FV. It is after you have had this, you will now multiply this by the value of money now. That is the fair value. The person that derived this formula called the amount, the real amount, the fair value. But the formula is, if you want to know the present value of 5 million naira as at that first day of January, we are going to be saying 5 million naira times 1 over 1 plus R raised to power n. This I stands for R. But now, when they now multiply that 1 by that 5 million, they have this formula. So, okay, let me use this formula. This is what we can find now. That's the formula for present value of money. So, what they are trying to say is that we have the money, the cost, the real amount, the amount of money paid. Amount is what? The amount of money is 5 million naira. The amount of money, 5 million naira. That is the real cash that the company paid. But we want to know how much should be recorded in the financial statement. They have told us that the interest rate, INT, is 6%. The interest rate is 6%. That's the interest rate. And then we say the N stands for the number of years. This is just 1 year. If you look at that question, it says it was purchased in January, same year, and paid in December, the same year. So N, our N in this case stands for 1 year. 1 year. Our N stands for 1 year. So that's it. Those are the informations we need to input into this. Information we need to input into this question to calculate the present value. So what we are going to be saying is the present value of money now, that is this machine. At what cost will this machine be recorded in the financial statement? We put the formula here. I'm trying to replace that formula with this. At what cost will this amount be recognized in the financial statement? So we're going to be saying, to recognize it, we'll say 5 million times 5 million times the formula. But now, I put 1 over 1 plus R for my own. They have multiplied that 1 by 5 million. So eventually, to use the formula we have here, we just be saying 5 million now divided by, we open a bracket. Now, our R is 6%. Our R is 6%, and 6% is 0.06. So say 1 plus 0.06. Now, because our N is 1 here, it does not need for us to put it there, because raised to power 1 will still be 1. So what we are going to be doing is to divide 5 million by 1.06. We are going to be dividing 5 million by 1.06. That's the amount. So the amount is, so this one will now become what? This will become 5 million divided by 1.06. When you add that to this, it become 1.06. 5 million divided by 1.06. That's what we are going to be having as this formula. And what that is going to be, that one will give us, equals 5 million, that is this amount, divided by this amount. This is the amount at which the cost of this machine will be recorded. The cost of the machine will be recorded at this amount. I want to believe everybody understands what we are trying to say. The machine will be recorded at this cost in the financial statement. This is the cost of the machine in the financial statement. This is at what amount the machine will be recognized, cost in the financial statement. Now, the other part of this is going to be the interest. The interest is the difference between the 5 million that was paid and the amount that is actually going to be recognized. That's going to be the interest element. So that when we add the two together, we'll be able to have 5 million naira. Now, how are we going to post these transactions in the financial statement? How are we going to post this transaction? If you look at it, they say a company buys this machine in January, they paid in December. How much are we going to be recognizing in respect of this machine? What we are going to do is to recognize this amount of money. That is the cost at which the machine will be recognized in the financial statement as at the day of purchase, which is 1st January 2027. So I'll now be showing us the double entry for this recognition. If we are going to recognize 4,716,981 naira, and how are we going to be recognizing the 283,019 naira that is actually meant for interest? The system is trying to load that. I'm trying to bold this thing. It's showing loading. Now, okay, so the double entry. Let me just start the double entry. The double entry treatment for this transaction. So the double entry, we have here our debit, CR, and we have here our credit, CR. The double entry with debit the machine with the amount that you actually going to be recognizing at cost. So machine, the machine account, you debit it with the cost. And since you have not paid, you credit your liability with the same amount of cost that you recognize. That is debit and credit. Debit the machine, which you recognize as the asset, and credit the liability with the same amount. Then the second transaction will be that you debit the interest expense, interest in the statement of profit or loss, interest expense. Expenses are usually of debit transaction. Debit this machine, debit the interest expense with the interest element of the transaction, and also credit your liability. Liability again, that is interest payable. Interest payable. Interest payable will now be credited with the amount of the interest again. So when you do, it's going to be the double entry principle over this transaction, so that when you add them up, they will all gross up to 5 million naira. So this interest expense will be written off in the profit or loss at the end of that year when the statement of profit or loss is being prepared. You debit it, you are going to remove it from profit or loss. It's an interest element on that transaction, while this amount remains at cost. So if we are calculating depreciation, let's say this machine has 4-year useful life, depreciation will be based on this 4,716,981 naira. Do we understand this transaction? Do we understand this transaction, or you have a question that you should put in the chat box? If it is understandable and we can move on, just say yes. If you have a question, just ask your question. I want us to be using the chat box. The class has to be interactive. What this transaction I just posted, if you understand it, there's no question. Say yes. If you don't understand it, just post your question. Just post your question. Okay. Mr. Tosin say yes. I'm waiting for, okay, Dorothy says yes, you understand it. Who also wants to say something? Mr. David, Adam Bimbo, are you also there? So if you understand it, if it is clear enough, as I've just explained it, just use the chat box. Okay, she also says yes. Mr. David, are you also with us? Okay. So this is what we call thank you. Everybody says yes. That's clear enough. So that's it. That's the transactions that will be done. The double entry is here. The double entry will be here. Double entry is here. Then we have the debit and credit column. They are there. And then this is going to be the postings. So this is what's going to happen in our general ledger. Machine will carry 4.7. Then the interest element is 283,019 naira. So we go on. That's how to recognize an equipment upon initial measurement. That is if the payment is deferred, if we are not paying it immediately. If we pay that cash as of January, there's no need for us to be looking for interest element. It is just the 5 million naira that will go to the account of machine. But because we are paying the 1 million naira in 1 year term, it means that there have to be interest element computed on that. It does not mean that we are paying this interest separately from the 5 million naira. What we are going to give the person at the end of 1 year is 5 million naira, but it has the element of cost, which is 4.7, and it has the element of interest, which is 283,000. So let's go on. So this is our example 1 today. Example 1. So let me just put it somewhere here. Example 1, in case you are studying it again. Example 1. So we have it there. It covers to this place. Example 1 that we have today, which deals with what the initial measurement if the payment is delayed beyond the immediate payment, if it is paid later. So now we go on. We have treated this example, then we go on to exchange transactions. What do we mean by exchange transactions? Exchange transaction is just that you have one item, you are giving it, just like trade by barter in those days. I have a car, I give it to you and collect a plot of land. That's what they call exchange transaction. You are exchanging. Mrs. Bimbo said she has low battery, that her phone will soon go off. That's very painful. We are going to be missing you. As opposed to, okay, maybe this there is poor power supply in the country, and then the fuel is not even easily accessible. We understand. Of course, the videos will be on the group chat. If you go offline, we understand. The video will always be here for you to watch after. And if you have your question based on the video, you can always reach me after. That's the benefit of this class. So you're not going to miss any class at all. So exchange transaction. An asset may be acquired in exchange for another asset. The cost of such asset is measured at its fair value unless one. Now, what my then says that, okay, your company wants to buy a car and they have a plot of land they want to give to the vendor, that is the dealer, to collect a car. At what amount should that car be recognized in the financial statement? No, this time they are not paying money. They are exchanging one asset for another. So that's what we want to treat under this topic. We say the cost of such asset is measured at its fair value. That is, we are going to measure that car at the fair value of that car in the financial statement. Or let's say we are giving up a car to collect a plot of land. At how much do we recognize this land we are collecting in the financial statement? It's going to be at the amount of the fair value. Now say unless one, the first thing is exchange transaction lacks commercial substance. Now, to say that a transaction lacks commercial substance, I'll be explaining that shortly, is that when I exchange my car for a plot of land, that land is not going to increase my income in the foreseeable future. Then it means that transaction lacks commercial substance. That is, you give up an asset for another asset, and the asset you collect is not going to be adding any value to your company better than your company was before collecting that asset. We say it lacks commercial substance. So it says the fair value of neither the asset received nor the asset given up is reliably measured. That is, if we cannot, okay, we say unless, look at the cost of such asset is measured at its fair value, unless the fair value of neither the asset received nor the asset given up is reliably measured. That is, we cannot measure the value of the car we gave, we cannot measure the value of the asset we receive. If we can't measure any of those things, then we say an asset may be acquired, the cost is what the cost of the asset is measured. The cost of such asset is measured at its fair value. That is, when us, if we don't know the value of the asset we gave up, we don't know the value of the asset we received, then we can just use the cost of this asset we just received if we don't know the fair value. Next, I say if the new asset is measured at fair value, the fair value of the asset given up is used. That is, if we are using the fair value of the land that we are receiving, then we must use the fair value of the car we have given up. Well, the difference between fair value and carrying amount, let me explain that to you. When you buy an item like that machine that they bought for 5 million naira, that we recognize at 4.7 million naira, when we start depreciating it, what remains is the carrying amount. But now that is in the financial statement. But the fair value is at what amount that we can sell it outside, or at what amount is that kind of machine as at a particular date. Let's say after 2 years of depreciation, we want to determine at what amount the vehicle should be, the machine should be made. That's the fair value. There's a standard called the fair value measurement. We'll get to there and we understand how they measure fair value. So if we can't determine the fair value of this car we are giving up, we can't determine the fair value of this land we are receiving, then we use cost. We calculate it in another way. Or if we can determine once we use fair value of one, we must use the fair value of the second to also measure what we are doing. Then the last we said, if the new asset is not measured at fair value, its cost is measured at the carrying amount of the asset given in exchange for it. So we now say, okay, if we can't know how much the land is, then the car we are giving out has a value in the financial statement after depreciating. So that amount that the car carries in the financial statement is what we are going to be recognizing as the value of the land we have purchased. So the car that has a value of 1.5 million in the financial statement as carrying amount is being exchanged for a plot of land at somewhere remote. We don't know how much land is worth in that place, but we want to recognize the land in our financial statement. We'll use the value of the car we are giving up, which is 1.5 million, to recognize the land. That is if we can measure the fair value. So this will be the case when the exchange lacks commercial substance. That is when the exchange lacks commercial substance. That's the case. And so when we talk about lack of commercial substance, is there lack of commercial substance? The determination of whether an exchange transaction has commercial substance depends on the extent to which future cash flows are expected to change as a result of the transaction. How the future cash flow will change as a result of the transaction. That's how to know if a transaction has commercial substance or not. See, if there is minimal impact on future cash flow, then the exchange lacks commercial substance. So, for instance, and one thing we call asset, because we need to separate it, the asset and liability. I know you have a background knowledge as to what an asset and liability is, but if you have a thing that does not generate money for you, and that thing costs you money, that is not an asset. That's it. It's not an asset. Asset is a resource that will bring in cash inflow in the future. You have right and control over the resource, and it can bring in money for you. So, for instance, you give up a car that maybe the MD is using a car, and just think, the company needs a land somewhere, a plot of land somewhere. You now give up that car to collect the land, and maybe the land is in one remote place that even for the next 5 years, that land is not going to bring any money to the company. That is not an asset. That's not an asset, or it lacks commercial substance. It's not bringing in money. We can only recover the value of that land if we sell it. So that is, it's no longer an asset. Where that it will become an inventory. If we buy an item for the purpose of selling, it will be an inventory, a short term, if you are selling it within a year. But you buy a property, you invested into a real estate property, and you are not using the land for rental purpose. That is, you'll be bringing money to you every year. You just have it there as if you save your money there. That is going to be an asset, but that exchange transaction, we will say it lacks commercial substance. It's not going to change the cash flow. Look at this. The determination of whether an exchange transaction has commercial substance depends on the extent to which cash flows are expected to change as a result of the transaction. So if it does not going to change the cash flow, that land is not going to be used for rentage to the company, and it's not going to be bringing money to the company. We will say the transaction lacks commercial substance. So next we have elements of cost. If we say we want to recognize a transaction as cost, what are the items that make up the elements of cost? What are the things we have aggregate together that we arrive at the cost of that item? Okay, the cost of an item of property, plant, and machinery consists of: one, its purchase price after any trade discount has been deducted, plus any import taxes or non-refundable sales tax. So we buy a car for 5 million naira. That's the cash price we paid, that we're supposed to pay. That's the amount of the car. But the dealer says, okay, I give you a discount of 100,000. That's 4.9 million naira. But when you are moving the car, they say you have to pay import duties, and they say the import duty is 200,000. And we say, okay, there are some sales tax like VAT. If it's an equipment that's vatable, and that they are going to pay the VAT of 50,000 naira. Look at it. 5 million is the cash price. We deduct the discount of 100,000 from it. We have 4.9 million. We talk about the import duties, which is 200,000. We had it back, it becomes 5.1 million. And then the sales tax, let's say it's 50,000, then it becomes 5,150,000. That is going to be the amount of cost. Or the next one we say plus, then now plus the directly attributable cost of bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. Now, you bought that car, let's say you are buying it, that's the sales price, the discount, the import duties, all those things are paid, but then you need to fly the car to your country. Or if it's good, they are going to carry it across the border, you need to move the vehicle. The cost of moving it to where you want to be using it will also be added to the cost of that car. So we said this directly attributable cost may include, we're now listening, employee cost arising directly from the installation and construction of the asset. If that asset is going to be installed, the labor you are going to pay for installing the assets will be capitalized. Now you are following. First, we talk about purchase price, remove discount, add import duties, add any sales tax. Then we talk about cost of transporting it, that is carriage inward. If you remember in those days, carriage inward, cost of bringing the assets to where you want to use it, and the cost also include cost of, if you want to install it, you are going to bring in some experts to install the machines for it to be useful, or cost of construction, anything. Maybe they need to build a platform for the machine where it will lay. Is part of it. Then we go to cost of site preparation. That is the place you want to use this equipment. They need to clear the bush. They need to use caterpillars to pull some trees. They need to prepare the place for the user of this equipment. It's going to be capitalized as part of cost of this machine. Then we say carriage, delivery cost. That's part of cost of moving the items to where you want to use it. We talk about installation and assembly cost. That is, they want to piece this machine together, put this in that it needs for it to function. It's going to be capitalized. There's a testing cost to assess whether the asset is functioning properly. Net of sales proceeds of items produced during the testing. Now let me explain this. We bought a very big machine. Now we have calculated the cost, price, removing the discount, adding the duties, import duties, and all those things. We have added them to it, and then we have talked about the cost of preparing this. And I'm saying, okay, we want to test this machine. We want to test run this machine for the next 6 months. So we put in equipment, we buy raw materials, we begin to produce. The cost we run, the cost of running that test, and maybe in the process of running the test, we are able to produce some products in the process of running the test. So let's say, okay, we bought raw materials, we use this machine, we bring in labor, they work, and the purpose what we are doing that time is not that we have actually kicked off the operation of that machine, but we are test running it to see whether it will work well. So let's say we now produce an item that is worth 500,000. That is, the items we produce during the testing period is 500,000. And then maybe the cost of running those testing period, the labor that was, the fuel, the oil, everything we do that time is amounting to like 800,000. It's possible because we're just test running. Now, we are going to be removing that 500,000, which is the proceed, the sales proceed. That is, we now sell those products for like 500,000. The sales proceed of that 500,000 will be deducted from the cost of all the cost of test running the machine. And then the remainder will be added to part of the cost that's going to be capitalized. Then there's the professional fees directly attributable to the purchase. So if you are going to buy a land, if it's a land, for instance, or if it's an equipment, and a lawyer has to do some documentations for you, you can see what make up the cost. The lawyer has to do documentations for you, or a professional like a valuer is engaged in valuing it, or you bring in some all these actuarial scientists, all those professionals. If there's any of them that is going to be involved in either purchase or in installing this equipment, all the money we pay to it will be capitalized. And that is the cost of dismantling or removing the asset and restoring the site where it is located. So let's say, okay, this machine we are buying, we're going to use it for 5 years at a particular location. And government has given us approval that we're going to be using this machine there. But the government gave us as part of their condition at the beginning of this agreement that when we are done with whatever we are doing in that place and we want to leave the place because it's a temporary site, we must make sure that we make correction to everything, clean up the entire area, restore the site to the condition it was before we came. If they tell us that today, and we are going to be paying that money in 5 years' time, we need to calculate the present value of that money and add it to cost of the equipment today. You see, that's how complicated it is, what make up the element of cost. So we'll be treating that, we'll be using an example, to deal with that issue, an example to treat that issue I've just said. Now, said example, a company has purchased a large item of plant. The following costs were incurred. That is when they bought the land. These are the costs. The list price of the machine, 1 million naira. Trade discount given, 50,000 naira. Delivery cost, 100,000 naira. Installation cost, 125,000 naira. Cost of site preparation, 200,000 naira. Architect fee, 15,000 naira. Administration expenses, 150,000 naira. Test run cost, 75,000 naira. Now, so the test run cost was to ensure that the asset was installed and working correctly. That explanation I gave us earlier, to test run the machine. So he said items of inventory were produced during the test run, and this had a sales value of 10,000. During the test run, we are able to produce some items and we sold those items for 10,000 naira. Now, the local officials have granted the company a license to operate the asset on condition that the company will remove the asset and return the site to its former condition at the end of the asset's life. Now, say the company has recognized a liability of 250,000 naira in respect of the expected clearance. Now, let me explain this very well because we'll be making some more complicated questions. They said now the company has recognized a liability. This is not the amount that government charged them, but this is the amount of liability they recognize, 250,000. Now, if they have told us that the government says they will pay 300,000 naira, and we say that is going to be payable in 5 years' time, we must calculate the present value of that 300,000 naira today using the formula we used previously on that first example. That is, it will now be 300,000 naira divided by 1 point, whatever the discount rate is, raised to power 5. That is here, this n here, we raise to power 5. We will discount it to the present value. But in this question, they are not saying we should do that because they said the company has recognized, that is, they have done their calculations and they said 250,000 naira is what is expected to be the nearest cost. So at what the requirement of this question is, at what cost do we recognize this plan in the books and the financial statement? So we will go and use our worksheet again for example 2. Example 2. Use our worksheet again for example 2. Example 2, just for us to know how this item should be recognized in financial statement. So I'll type example 2 here. And what we're going to be doing, we have the column for costs, which is the amount of money. And then we have the columns for the items. So the first thing we are recognizing is okay, we are going to be having 2 columns for the money, so that we'll be able to use a clean computation for it. Okay, I can also round it to the nearest 1,000. Round this money to the nearest 1,000. To the nearest 1,000. Now, so we go to the question. The first thing says list price of the machine. That is how much the machine was actually priced. The value, the list price, is the price tag on the machine. It's 1 million naira. So we say machine price. That's okay. Let me just do a thing so that we have proper labeling for this. We say cost of machine. Example is cost of machine. Cost of plant. Cost of plant. Cost of plant is what we want to calculate. So we say price, list price, list price. List price of the plant is what? 1 million naira. So we put 1,000 here since we have rounded to the nearest million. And discount. A discount, trade discount is given. Discount. How much is the discount in the question? Trade discount given is 50,000 naira. So we come here and put the 50,000. 50,000 naira will now be what? 50. 50 here because we have we have rounded it to the nearest 1,000. So 50. That one is going to be a negative figure. We will deduct that from here, and then we put the figure here. So this is this figure. We are deducting this second figure from it, and so this is going to be the price, the list price of that machine, the list price of that machine. And we can also do it on a straight line if we just want us to have it. You can just say this minus 5, 50, Jerry. This minus 50. This amount minus 50. Just for us to have it on a straight line. So this amount, the discount. We are removing a discount from it. So the amount will just be what? 1,000,000 minus 50. You know what I mean? That's 950 naira. That's what it will be. 950,000 naira. That's what this will be when we treat it that way. You know exactly what I've done here. What we're trying to do is to deduct the discount from the real price tag. Now, that's the first element. The second issue here says the delivery cost is 100,000. So we come here and type delivery cost. Delivery is 100,000 naira. 100. Then we go on. The next thing says the installation cost is 125,000. So installation. How much again? Installation cost is 125,000. So 125. And then the next item there says the cost of preparing the site, the cost of site preparation, 200,000. Cost of site preparation. Site preparation, 200. And then next to that we have architect fee. That's the professional fee, like we explained, 15,000 naira. So we come say architect fee. Architect fee. So that's how much again? Architect fee is 15,000. So 15. Since we have rounded it to the nearest 1,000. And then we go further to say administrative expenses. This is not going to be part of the cost of the machine. This is just an administrative expenses. It will be expensed in the statement of profit or loss. It's not going to be part of the cost. So the next thing is cost of test running it. That's cost of test running it. We are not going to be deducting the money we generated from the product we sold. The 10,000 naira must be deducted from this 75,000 naira. So if we come here, we say test run, test run, test run. And for test run, what are we having? For test run, we are having the 75,000 minus the 10,000. Do you understand? 75,000 minus the 10,000. That's the cost of test running the machine. This because the entire cost 75,000. Now say the test run was to establish that the machine was installed and working correctly. Items of inventory were purchased during the test run, and this had a sales value of 10,000. So the net of this is what's going to become cost of test run, which is what? 75,000 minus 10,000. That's 65,000. Finally, they said the local government officials have granted the company license to operate on the condition that they will remove the asset at cost of restoring the site. And here, that is 250,000. That we say cost of clearance cost. We can just call it clearance cost. Clearance cost. So for clearance cost, 250,000. 250,000. So we gross up this. We gross all of this up. And when we grow this up, that becomes the cost we are going to be recognizing respect of this financial, this transaction, this plant. That's going to be the cost. So if we paid immediately, we'll have a double entry. If we pay the money immediately, we have a double entry, and then debit, credit. If we paid immediately, we are going to debit the assets, that is the plant, will be debited with this amount of money, 1,705,000, and bank will be credited. You know that bank will be credited the same amount of money. If it is on credit, of course, liability is what we are going to be crediting. That is how to recognize cost on this transaction. That is how to recognize cost on this transaction. Do you understand or you have a question regarding this transaction? It is clear enough how they want this to be done. It's clear enough how they want this to be done. It's clear enough how they want this to be done. Just 1 minute. Example. Okay. So that's it. If you have question, can you quickly ask the question in the chat before we move on? I'm just trying to move examples to where it is. Do you understand that? Do you understand that? Any question? If you understand, say yes. So I just quickly go. Or if you have any question, quickly type the question because of our time. I want us to achieve more this today. So if you have question, just type the question. If you have question, type the question. And if there's no question, let me quickly move on to the next thing. So that's how to recognize the initial cost. That's clear enough. Next, it's a cost of self-constructed asset. If this company is producing like a car manufacturing company that now wants to produce car that its employees will use, how do they recognize those cars in the financial statement? They said the cost of a self-constructed asset is determined using the same principle as for an asset acquired. Then a company might make similar assets for sale in the normal course of business. The cost of an asset for the company to use itself will normally be the same as the cost of an asset for sale as measured according to IS2. That is, we're going to be measuring it at the same cost of producing the ones you want to sell. So let's say a Mercedes company that produces Mercedes-Benz is now thinking of, okay, want to give all our employees Mercedes-Benz. When those items come out of the factory, they will be, while other Mercedes-Benz vehicles will be treated as inventories, those ones that the companies want to be using will be treated as PPE. You see, it's the same, coming from the same company. But for as long as they will be using this one, the employees are the ones that they want to give these ones to. They will treat those ones as PPE. Whereas the orders that they are displayed for sales will be treated as inventory. Now, the same cost of that inventory, I said the value at which you recognize the inventory. If you remember under cost accounting and performance management, if you have been studying performance management, those of us who attended the last class, we did something about it. Those of us who have done cost accounting, you know how to value inventory, that you produce, how that you derive the cost of production, cost of materials, cost of labor, overhead cost, and we arrive at the cost of producing the inventory. And if we are using absorption costing, how we absorb the fixed cost into it. If it is marginal costing, how that cost of fixed cost will not be part of it. So that same value is so I say, okay, it costs us 15 million naira to produce a particular Mercedes Benz, and that is going to be the cost of the inventory in the financial statement. That same Benz that is given out to the MD or to the accountant or whoever will be valued at that same 15 million naira. But this time, it will be recognized as PPE, while others that are displayed for sales will be treated as inventory. That is, the one given to the employee will be treated as a non-current asset, while others in the same bank will be treated as current asset. I'll talk about IS 23. It's a standard we are going to be learning. That is, IS 23. Let me just give us a little background to it. You want to build a factory or a warehouse. You now go to Zenith Bank. You borrow money to build a warehouse. It will take you 3 years for you to complete the warehouse. Now, that money in 3 years will have an interest in Zenith Bank of, let's say, 500,000 naira. Now that they have collected that money from Central Bank, you are going to be spending it, all the interest that you pay on the money you borrowed, for as long as that asset is being constructed by you, underlying qualifying asset, we call them qualifying asset. That is, you are building them. They have not become asset, but you are building them. All the interest you pay during that time will be part of the cost of that building eventually when it is fully built. When we get to that standard, we understand the IS 23 borrowing cost. Then that explains how we capitalize that. So if to say, okay, this manufacturing company, they have gone to borrow money, the Mercedes-Benz production company has gone to borrow money, and now they have prepared these cars. Some of them are inventory, some of them are going to be PPE. All the interest they pay on loan will be added to the cost of that asset. We understand that when we go further under IS 23. Now we say not part of cost. What are the costs that are not part of cost that we use in capitalizing PPE? We say only those costs necessary to bring an asset to a condition and location where it is capable of operating in the manner intended by management are recognized. Now, the IS system provides the following list of costs that are not cost of an item or property, plant, and equipment. These parts are not part of cost of these items. One, cost of opening a new facility. No, you want to do opening ceremony, or you want to open a new facility. It's not going to be part of the element of cost. They are going to be, okay, for instance, now we want to dedicate a building we just built. It's not going to be part of cost. Or we want to go and open a new facility at Ikorodu, and so we want to buy machine. It is the cost of those machines and those things we listed earlier that will be part of the element. Every other cost is not going to be part of it. Next, is the cost of introducing a new product or service. That is your research and development, advertising, promotional activities. No, that's not going to be part of the cost of those equipment. The cost of conducting business in a new location or with a new class of customer, including cost of staff training. No, you go and hire staff, you are training them to use that machine. That's training cost. You just bought a machine, you are now training staff how to use that machine. No, that cost or you spend on training is not going to be part of cost you are going to capitalize. We say now, next, we say administration and other general, like I did in that previous example, when they said administrative expenses. We didn't include it because it's not supposed to be part of the cost that we capitalize. So we now talk about subsequent expenditure. Which of it should be capitalized? Now we have bought a vehicle we want to be using as a company. Now we are spending money on that vehicle in the future. Which of it should be treated as part of the cost of that vehicle that we capitalize? Expenditure related to non-current assets after initial acquisition should be capitalized if it meets the criteria for recognizing an asset. And when I say in practice, this means that expenditure is capitalized if it, one, improves the asset, for example, by enhancing its performance or extending its useful life. If that money you are spending on that car is not to extend the useful life of that car, you don't capitalize it. You don't capitalize it. For instance, you buy a vehicle and then you just think of changing some items in it. That items you are changing is just like you are repairing it. It's not as if you are using it to enhance how long the car will last. That's not going to be part of the element of cost. But if that thing you are doing is to maybe you just buy a new engine, you buy a car that has an old engine, you now go and buy a new engine. And the purpose of that, is so that if this car initially will last for 1 year, this new engine will make it to last for 3 years. That will be capitalized. Or you just buy a car and you think, okay, you need to change all the tires. The tires are already old. You now go and buy the tires. The purpose is not because you are repairing tires. You are buying new ones so that the life of the vehicle will be longer. That will be capitalized. But if it is just to maintain, to repair and maintain, look at the last sentence. The second one says, is it for a replacement part? Okay, sorry. If it is for a replacement part, provided that the part that it replaces is treated as an item that has been disposed of. So what they are saying is that you have a car, it has an old engine. You now go to buy a new engine. This is how to treat it. The new engine will be capitalized as if you just bought a new PPE. Whereas the one you sold, the amount you remove from it, you have sold it. You see, you sold the one you remove from it, and the proceeds of it must be deducted from the proceeds from the cost of the new one you bought. So you remove an engine, you sold it for 50,000 naira. You bought a new engine for 150,000 naira. The 100,000 naira is what you are going to capitalize. So finally, I say repair and maintenance expenditure is revenue expenditure. That is, you repair, you change oil, you bring in a mechanic to service it, you bring in the rewire, or what do we call them, to just work on it, or panel to come and polish the body. All those things are repair and maintenance, and they are to be treated as revenue expenditure. That is, they are going to be written off in the statement of profit or loss for the period. They are not going to be capitalized. Now we talk about major inspections. A company might only be allowed to operate some assets if those assets are subject to regular major inspections or what. That is, this equipment we want to buy, we have to inspect it every year to see, or every 2 years, or every 3 years to see whether it has fault. Now, the cost of such major inspection is recognized in the kind amount of the asset as a replacement of the recognition criteria. So if the recognition criteria are satisfied, we are going to recognize the cost of that overhaul. And there's an example here for us to see how that is done. So when a major inspection is carried out, any remaining kind amount of the cost of the previous inspection is recognized. Now, this is what they are saying. Let's look at this example. Major overhaul. A shipping company is required to put its ship into dry dock every 3 years for an overhaul at a cost of 3 million naira. The ships have a useful life of 20 years. A ship is purchased from a shipbuilder at a cost of 200 million naira. The requirement is, at what cost do we recognize this ship and how do we treat the 3 million naira? Now, let me explain before I open my Excel sheet where we do the working. At the initial purchase stage, when they are paying 200 million naira for this ship, it is going to be inspected after 3 years, and the cost of inspection after each 3 years is 3 million naira. So definitely we are going to be separating the 3 million naira from the 200 million naira and treat it as a PPE on its own. Cost of inspection. We are going to capitalize it separately and treat it as a PPE so that every 3 years we'll be depreciating the 3 million naira. Every 3 years, and why we will depreciate the other remaining amount separately. So this is it. Let's do this example as our example 3. Example 3. Example 3, let me come down here to do example 3. So example 3. Example 3. Example 3. So in this, we want to be seeing how these should be treated. So we have here the Naira sign. The Naira sign rounded to the nearest 1,000. Another one here, rounded to the nearest 1,000. Now, the first thing we are recognizing is the cost of purchasing this, the cost of building these ships, the cost of purchase of those ships, 200 million naira. So we say ship cost, purchase cost. Okay. There's always need for us to put the heading of what we are treating. Cost of ship, cost of ship, cost of ship, cost of ship. That's what we are treating, cost of ship, and then we have the purchase cost, purchase cost, purchase cost, purchase cost. And how much is that purchase cost? We call it 200 million naira. 200 million naira is here. 200 million naira. So I'm going to be typing 200,000 here. 200,000. Since we have rounded it to the nearest 1,000. 200,000 is there. And then we'll say cost of overhaul. Cost of overhaul. Cost of overhaul is what? According to this question, the cost of overhaul is 3 million naira. So we are going to be putting the 3 million naira here. But this time it's going to be negative 3 million naira. 3 million. I put 3,000 there. It should be 3,000 because we have rounded to the nearest million. And so we are putting it in jacket. So upon initial recognition, we are going to be recognizing this ship at the rate of 197 million naira. We will separate it, sorry. Yes. We separate it we separated the cost of overhaul from the cost of the ship. So upon initial recognition of the ship, we recognize 107 million naira, even though we paid 200 million naira. But we already know as part of the element of cost is this 3 million naira that every 3 years we are buying it now. But in 3 years' time, we must do an overhaul inspection on the plant for 3 million naira. We'll separate the cost, the purchase price, from the total amount from the purchase price. We will deduct what we call the element, the overhaul cost of it. We are going to be having the initial cost of the machine, which is this amount. And so we are going to be having the double entry here. The double entry will now be the double entry, double entry, double entry, the double entry, and the double entry will now be this debit, this credit. So we say the ships will be debited with 197 million, and this will be depreciated over 20 years. Then overhaul will also be capitalized. Overhaul will be capitalized and also is debited with what? The 3 million naira. Debited with 3 million naira. The overhaul debited with 3 million naira, which is this. And so we have that. And so we'll credit the bank. If we have paid cash, we credit back with 200 million naira. 200 million naira. That's the double entry. But if we have not paid, it's on credit. So now we will depreciate these two things separately. Why this will be depreciated is ship. Let me now talk about depreciation. Depreciation. Now, why the ship will be depreciated? Depreciation. The ships, which is 197,000, has 20 years useful life. 20 years useful life. So let me type the depreciation. Okay. I'll put the costs. Yeah, I'll put here as cost. And I'll put useful life here. Useful lives. Useful life. Useful life. So it has, the cost is what? The cost of the ship is 197,000. It has 20 years useful life. Whereas the overhaul has a cost of 3 million naira. The overhaul has a cost of 3 million naira, which is what we have done here. 3 million naira. And it has 3 years useful life. 3 years useful life. That's it. 3 years useful life. That's how the overhaul will be treated. So why we depreciate this? So if we are doing annual depreciation now, annual depreciation. Now, if we are doing the depreciation charge for each year, why this one will be divided by 20 years, that is the 197 divided by 20 years, annual depreciation, this will be divided by 3 years, that is the 3 million naira will be divided by 3 years. This is the annual depreciation. This is how we are going to be treating the depreciation charges for each of these items, so that at the end of 3 years, this one will be fully depreciated, and another 3 million naira will be recognized as cost. So if you have a question like this in examination, this is how to treat it. Separate the cost of overhaul from the cost of the vehicle, as from the cost of the equipment, and then depreciate them separately. Depreciate the items of ships separately, depreciate the overhaul separately. These two depreciation will go to the profit or loss, and then it will be credited to the accumulated depreciation. That is how this example will be treated. That's how this example will be treated. Do we all understand what we have just done here for this example 3? Or you have a question? You have a question, quickly use the chat box, put the question there if you have a question. But if you don't have a question, we can quickly proceed. I can see just 3 of us, Mr. Michael, Mr. David, and Dorothy. We are still here, and I can see that we are listening. So if you have question, if you don't have question, say I'm okay, so that quickly go on. And just use the chat box and say okay, or say yes, whatever. Just say, confirm that you can hear me and that you're okay. Okay, person says okay. Dorothy, are you there? Mr. David, are you also there? Mr. David, are you there? Just respond by saying okay, so that we can move on. Okay, you say okay. Dorothy, are you still with us? Can you also use the chat box and just let us know that you understood what we have done, that you are saying okay. How to separate cost of major inspection from the cost of the equipment upon initial recognition. Upon Dorothy, I'm not seeing your chat. I hope you can hear me. Although I can see you online and it shows that you are listening. But I'm waiting for you to also put in your chat so that we know that you are part of what we are doing. Very, very important. Nobody should be left behind. Next, we go to measurement after initial recognition. Now, we know there are 2 models for measuring PPE, the cost model and the revaluation model. Upon initial recognition, we use cost or fair value depending on the conditions. Those what we have just treated. The 3 first example we treated is upon initial recognition. That is what we do if the payment is deferred, what we should do, for example 1, and the things that make up the elements of cost, for example 2, and then for example 3, we talk about the equipment that has major inspection, how we separate it at cost. So we now go to a subsequent measurement now, that is measurement after initial recognition. We use cost model, and that is the one that says, okay, we carry it at cost less accumulated depreciation. And then the revaluation model. Property, plant, and equipment is carried at a revalued amount. This is the fair value at the date of the revaluation, less any subsequent accumulated depreciation and any accumulated impairment losses. That is, there's an accumulated impairment losses, we deduct it, or depreciation. That's revaluation model. We now say the above choice must be applied consistently. A business cannot carry one item of property and plant and equipment at cost and revalue a similar asset. Let's say, okay, we have motor vehicles. You cannot say, okay, for this car, Mercedes, we will use historical cost model. And then for this car, Toyota, we are going to be using revaluation model. No. As long as they belong to the same class of item of property, plant, and equipment, you cannot use separate model for valuing them subsequently. You cannot be saying, okay, cost for Honda and evaluation for Mercedes. No, all motor vehicles will be treated either using the cost model or evaluation model. However, a business can use different models for different classes of property, plant, and equipment. So you can revalue, you can use revaluation model for land. You can decide to use it for building, while you use cost model for motor vehicle. You might decide to also say you want to use cost for building and then revaluation model for motor vehicle. If you have different class of asset, you can decide to use different model for revaluing for measuring them subsequently. But you can't use different model for the same class of asset. So we talk about depreciation and carrying amount. We know what depreciation is. It's a systematic allocation of depreciable amount of an asset over its useful life. And we talk about depreciable amount, which is the cost of an asset and other amounts substituted for cost less residual value. That's depreciable amount. And we know what residual value is, which is the value of the asset. It's an asset. Okay, the residual value of an asset is the estimated amount that an asset would currently obtain from disposal of asset after, the residual value of an asset is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal if the assets were already at the age and at the condition expected at the end of its useful life. I'll talk about useful life, the period over which an asset is expected to be available for use by an entity. 2, we said the number of production or similar units expected to be obtained from the asset by an entity. Let me separate this by an entity. So let's say carrying amount. You know what carrying amount is? Is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment losses. We call it also net book value. It's a term that is often used. This is often a term that is often used instead of carrying amount. We normally use net book value, whichever one we use. Now we say part of an asset. Each part of an asset that has a cost that is significant in relation to the total cost of the item must be depreciated separately. Now, this is very complex. We need to understand. If asset has separate cost and equipment of a plant, for instance, that has different parts that have different significant costs, and by the nature of those items, they don't sell these parts together. You need to buy them separately and connect them together before they become one to function well. And the cost for each part is significant of the asset. We say they must be depreciated separately. This means that the cost of an asset might be split into several different component assets and each depreciated separately. Okay, for instance, let's look at this example illustration. A company has purchased a new Gulfstream jet for 550 million naira. The company has identified the following cost component and useful lives in respect of this jet. They said the engine is 2 million naira and it's only in 3 years that the engine will back. Now look at the conditions that will make us do this part depreciation separately. If you look at this example, you see that it is one equipment, Gulfstream, but it has 4 different parts and 4 different useful lives. That is, in 3 years, the engine will pack up. In 10 years, the airframe will pack up. The fuselage will last for 20 years. And the fittings, 500 million, will last for 5 years. This is the condition that will make us to depreciate them separately. So let's say we have, let me just use a common equipment, for instance, a vehicle that the tire has different useful life, the engine, different useful life, the body, different useful life. That particular vehicle can be depreciated separately. Sorry. Let me just take water to water that down. Are you still with me, everybody? Dorothy, are you there? I can't see your chat. Okay, Mr. Davis says yes. Mr. Tosin, are you there too? Just type yes if you are still there. Okay, Statosin says yes. Dorothy, I'm not seeing your chat, but it shows that you are listening. That's fine. Now, so this is an equipment. Okay, Dorothy says yes, thank you. This is an equipment with different parts, and each part has different useful life. How do we depreciate this item? Let's just treat the example as example 4. Example 4. Example 4. Example 4. And so we are going to be treating how these items should be depreciated. These are an item. So first I will list what we have here in that place. The name of the item is Gulfstream. 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 And so it has the amount here, cost, and useful life here. Useful life. Useful life is here. So those things are there. And so the first item, let me put the Naira sign there. The nearest million. That's what this one did. The nearest million. And I put the same thing here. Now, engine. 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 Engine has a useful life. 2 million. That's 2,000 million. That's 2 billion. It's billion actually. What they said they are saying million, but it's supposed to be billion. Now, so 2,000. Yeah. The other item here is airframe. 1.5. Airframe. Airframe. 1.5. And then we have fuselage 1.5, fittings 500. Fuselage and next fitting. So this fuselage is also 1.5 and the fitting is 500. And so the useful lives for the first one 3 years, second one 10, third one 20. So 3 years, 3, 10, 20, 10, 20, and the last one has 5 years useful life. 5 years useful life. 5 years. So what we are going to be doing is, when we are doing depreciation every year, depreciation, annual depreciation, annual depreciation, annual depreciation, you know exactly what to do. Okay, so this is supposed to be years, not Naira. Years, useful life. This number of years that it will use. Now, so annual depreciation will just be that we depreciate it separately, even though they have one value in the financial statement. So please, they're very important. We need to understand exactly what we are talking about. They have one value that is in the balance sheet. You have an item called Gulfstream. Gulfstream in the balance sheet, which has a total balance of this upon initial recognition. But when you are computing depreciation every year, this is what you do. You depreciate this separately, that is this divided by this. You have it there. That's the depreciation charge for this engine, and so you do the same thing for the for the entire 4. And when you do, you aggregate what the depreciation charge should be. The depreciation charge, what it should be. So this is going to be the depreciation charge in respect of this item. So the net book value after year 1, for instance, the net book value, or call it carrying amount will now be what? The cost minus the depreciation. The carrying amount is now going to be this cost, that is this amount, minus this total depreciation. So it is in your workings. If they give you an examination, you will do the workings of this depreciation separately. You don't do it together and then conclude, because you can see there's no correlation between this and this, except you do a workings that shows that you have done depreciation separately, you have aggregated them, and then the accumulated depreciation is now 992, and you deduct it from cost, and this becomes the carrying amount in the financial statement. Do we understand? That's how this should be done. If they give us an examination that this item has a different separate parts, and this is the part, this is the useful life of each part, and this is the cost of each part, you calculate the depreciation for each one by one, so that you know that at the end of 3 years, this one will be fully depreciated, while this still has different years. Even though it is one item in the balance sheet, we need to also understand that this is how this should be done. That's for these items of separate parts. Let me move this down a little. Items of separate parts. This is how they should be treated in the financial statement. So, very, very important. For us to get that. So that is what we do about this. This example. These are example 4. That's what we treat about it. So next, we quickly go. Depreciation is tax and expense system of profit and loss. We all know that one. That is, you treat depreciation on the P&L. Now say unless, in the system of profit or loss over the life of the asset, unless it relates to an asset being used to construct another asset. That's another thing. If you are constructing another asset in a company, and you are using one asset to construct that asset, the depreciation charges of that asset you are using to construct another one will be counted as part of cost of the asset you are constructing. Very, very important. That's in this case, depreciation is capitalized as part of the cost of the other asset in accordance with the relevant standards. For example, IAS 2, which is inventories, IAS 16 PPE, IAS 38 intangible assets. You are producing an item, and that plant you bought is actually meant for the production of that item. Depreciation, for instance, you remember manufacturing accounts back in the days. Depreciation of those equipment of manufacturing will be charged to part of the cost of those products we produce. They don't take it to statement of profit or loss. They treat it in the manufacturing account. That's what we're trying to do here. They treat it, the depreciation charge will be charged into the cost of producing those products, not into the profit or loss account. So that's exactly what this standard is trying to tell us here. Next, we say commencement of depreciation. When does depreciation start? We'll soon be rounding off. We'll just take a few more examples and then we'll round up. We say commencement of depreciation. Depreciation of an asset begins when the asset is available for use. Once you have bought it and it's available for use. This means when the asset is in the location and condition necessary to be capable of operating the manner intended by management. Once this asset is available for use, they have put it where we want to use it. This item, we want to use it in an OSHOD. We have prepared the site, we have put it there. It gets to the site. That is when we start depreciation. Not until we start using it. Now, that is very, very important. So we take note of this in questions, because when ICANN will ask you, they will put it in that they bought this item and it's available for use on January 1st, 2020. But the company began operation in 2022 February. How should the asset be depreciated? That's how ICANN will charge you. Or they will just say prepare depreciation charge for that asset. Take note now that depreciation begins when the asset is available for use, not when they actually start using it. Please, very, very important. Not when they actually start to use it, but when it is available for use. Once the asset gets to where they want to use it, and there's nothing more delaying them other than maybe they have other things. It's not that the asset is still having issues. The asset is available for use, but they have not started using it. You start depreciating from the date that the asset is available for use. And then we talk about cessation of depreciation. Depreciation ends at the end of when an asset is classified as held for sale. Once you decide that you want to sell the asset, the day you classify it as held for sale, that's the day you stop depreciation. or when the asset is derecognized. This is a standard we still need to also study, IFRS 5, that is non-current asset held for sale and discontinued operation. And when it is and when the asset is derecognized, that is the asset no longer fulfills the definition of what we call an asset and we derecognize it. That's it. So depreciation does not cease when an asset becomes idle. Very, very important. Whether the company goes on strike, you now say you will not calculate depreciation. No, you will calculate depreciation. There is COVID-19, the lockdown, the company did not operate. That does not stop depreciation charges. Please take note, because when I can't test this question, as simple as we see IAS 16, there are a lot of complex, because we can't complete it today. It's so wide. Maybe by tomorrow class, we'll be able to finalize on IAS 16. It's not something we can complete in one class, because as we look at it as very simple, but there are some very technical aspects of it that if we don't pay attention to, we miss. Depreciation does not cease when an asset becomes idle or withdrawn or retired from active use. That does not mean you stop depreciation. If you have not classified it as held for sale and you have not derecognized it in the financial statement, you continue to depreciate. That's what they're trying to say. So we have an idea about land and building. This class will end at 7. We have 16 minutes more. We talk about land and buildings. Land and buildings are separate assets that are dealt with separately for accounting purposes, even when they are acquired together. You see, this morning there is not so much calculation. Tomorrow we are going to be doing a lot of calculations. All these things we are learning at the theoretical part, we will now be seeing application tomorrow. So it is important for us to have a background knowledge of what the computations will be, because I'll be bringing real life examples for my kind of examinations, and we'll be testing all these things technically. You can see, as simple as PP is, they test it at skills level, they test it at the professional level. So we'll see how I can bring out these questions by tomorrow. So we say land and building are separate assets and are dealt with separately for accounting purposes, even when they are acquired together. Land normally has an unlimited life and is therefore not depreciated. Yes, don't depreciate land. However, there are exceptions to this. If land has a physical attribute that is used over a period, then the land should be depreciated. That is, you are extracting sand from a particular land. That's depreciation. Physical attribute. You bought a land, there is rock inside it. You are breaking the rock. You are removing the rock. The land is depreciating. And an example is here. They say Okene Quarry has purchased a site for which they will extract gravel for sale to the construction industry. The site cost 50 million naira. It is estimated that gravel will be extracted from the site over the next 20 years. The land must be depreciated over 20 years. You see now, it is land, but we are going to be extracting gravel from that land. So it will be depreciating, because as you are extracting gravel, the gravel will finish. They said the gravel will finish in 20 years' time. So we will start depreciation. We bought the land, for instance, let's say we bought it for 50 million naira. We will be depreciating it over 20 years as we are extracting gravel from the sand. So that's what they're trying to say. The building normally have a limited life and therefore depreciable asset. Land is not a depreciable asset except it's a quarry site, but building will always be. So if, for instance, you buy a property at Surulere and they say this building is 300 million naira, now you will bring an estate valuer who will value the land separately from the building. The entire money you pay is 300 million naira, but the value of the land must be separated from the value of the building in the financial statement. So it's an estate valuer that will tell you, okay, a plot of land in this location here in Surulere is worth 150 million naira or 200 million. Don't forget, it is the value of the land that determines the value of the building sometimes, except the building is dilapidated. If the land is located in one place and they call the building 500 million, 800 million, 1.5 billion, whatever it is, the value of the land is always higher. So they will separate it from the value of the building, because the value of the land will never go down, rather it will go up. But the building will be depreciating every year. It will need renovation, and at times, when I think the maximum number of years according to standard is 50 years for a new building. So buildings are usually depreciated over 50 years, even for tax purposes, but the land is not depreciated. So always recognize it separately. The question will come and give you the value of building, and they will tell you the amount of the land. They will slightly tell you that's what ICANN does. They will just put the question somewhere that the land of that building, that the nested value has come and valued the land at also amount. You are required. That's what they do. So what you just do is look at how much they pay for the building, remove the cost of the land, the remaining cost of the building, depreciate it over the number of years that the building is supposed to last. Next, we talk about review of useful life. ISA still requires useful lives and residual values to be reviewed at each year end. That is, at the end of the year, the useful life of an asset must be reviewed. Any change is a change in accounting estimate. Now, I don't know, you have not watched the video on IS 8. It is important for you to know the difference between change in accounting estimate and change in accounting policy. Now, a review of the useful life of an asset is a change in accounting estimate because the useful life of assets are usually estimated. We are not certain how long an asset will last. No, but we can just estimate it because it's an estimate. If you now review it, it's a change in accounting estimate. And changes in accounting estimate is done prospectively. That is from the date the change is made. But if it's a change in accounting policy, it is done retrospectively. Retrospectively meaning you go back, you bought a car, for instance, you bought a car 3 years ago, and you have been using the historical cost model on that car, which is a policy. But now you want to change to revaluation model. You have to go back to that 3 years ago and start depreciating and valuing the vehicle as though the decision to revalue, to use the fair value revaluation model was made 3 years ago. So when you change accounting policies, you go back and correct all the ones you have done in the past. But if it's a change in accounting estimate, you do it from the date you made the change going forward. So an example you say, we say Benin City Engineering owns a machine which originally cost 60,000 naira on 1st January 2023. The machine was being depreciated over its useful life of 10 years on a straight line basis and has no residual value. On 31 December 2006, Benin City Engineering revised the total useful life of the machine to 8 years, down from 10 years. You are required to calculate the depreciation charge for 20x6 and subsequent years. Very, very important and technical question. So those of us who missed the class on IS 8, it's like one of the examples we treated. So I will quickly treat this now. And that's likely to be the last example because we have just 10 minutes more. Now, let me go to this, our Z sheet, and then I will take example 5. Example 5. Example 5. Example 5. Example 5 is actually talking about how change in accounting estimate is done. How change in accounting estimate is done. So, what we are going to be doing is we are going to take the cost of the vehicle, which is of this machine, which is 60,000 naira based on this question. So, machine, it has a cost of 60,000 naira. 60,000 naira. That's the cost of the machine. Sorry. Cost of the machine, 60,000 naira. The cost is 60,000 naira. And initially, when the machine was bought, on 1st January 20x3, they said the machine will be depreciated over 10 years. That is, it has 10 years useful life. So, talk about the useful life of the machine. Okay, let me just do it the way we need to do this so that we can have it as a table. So, if we put the Naira sign here, Naira sign there, I will say useful life here. Useful life. Put useful life here, and it was 10 years. 10 years that they said the machine will be useful. It will be useful for 10 years, initially when it was acquired. So, and that date of acquisition is what? Acquisition date. Acquisition date is what? 1st January 20x3. That's the day they bought it. So we need to have it 2023 20x3, sorry, 20x3, which is the first year. Yes, 20x3 up to 20x6. So up to 20x5, because this is December 20x6, that's when they revised it. So they have depreciated this vehicle from 20x3 up to 20x5. So let's have that, the table here, 20x3, 20x4, 20x5. This is 5 years. The depreciation for each year here will be this divided by 10. That's going to be the depreciation. So we are going to have this depreciation done over 3 years. That is it. So I'm coming. Equals this divided by this. And the same thing here. This divided by this. Annual depreciation. Now, when the useful life of the machine was reviewed, it now said that at the end, this 20x6 was when an expert now came on 31st December 2006. The next now revised the total useful life of the machine to 8 years. That is, this machine that was previously thought it would be 10 years was now revised at the end of 20x6 to have 8 years. And don't forget, we have had 3 years depreciation already. As at that date, as at January 1st, 20x6, as at 20x6, I'm looking for a way to present this table. Okay, let me bring this here and call it depreciation. Depreciation. Now, for the first 3 years, this is going to be the depreciation charge on these assets. Depreciation for the first 3 years. Now, in 20x6, depreciation charge will change. But how much is going to be the depreciation charge for 20x6? What we are going to be doing is that we have already depreciated this amount, 60,000, which was initially the cost. We have had 3 years depreciation on it. So accumulated depreciation will now be what? Cost. Then accumulated depreciation. Will now be the addition of the 3 years depreciation that we have done. That is, this plus this plus this. That's going to be accumulated depreciation as at this date. So let me quickly put a negative sign there so that we can have it properly done. Now, that's accumulated depreciation. So as at this day, the net book value of the asset, as at this day will now be the difference between this, which is what? 42,000. That's the net book value as at this day. 42,000 naira. Now, the policy changed in 20x6, and they said the entire life of the vehicle is 8 years, meaning that it's only 5 years remaining. We only have 5 years remaining. That is 20x6, 20x7, 20x8, 20x9, then 20x10, or we call it x10, whatever they want to call it. Now 1, 2, 3, 4, 5, so that everything will be 5 years. So what will happen is that there are only 5 years remaining. The depreciation charge will now be based on the number of years remaining, the carrying amount divided by the remaining useful life. So initially we have this. I'm looking for a way to present it so that it can be properly presented. Depreciation. Let me take that down. So I'll say this is the issue as at This is the initial measurement upon initial value. So I'll call this initial value, initial or policy. Initial estimate is an estimate, initial estimate. So this is initial estimate that it has 10 years useful life. And based on that, we are now going to be having accumulated depreciation based on this amount of money. This is going to be, let me take that here too, for proper presentation, so that when you are looking at it, you'll be able to see exactly what we have done. So I will grab this in a box separately from every other thing. So assets, this is assets as at 1st January 11 X6. This is the kind amount as at 1st January 11 X6, 11/X6. That is as the kind amount. That is as at the beginning of that year, 20X6. So in 20X6, the remaining useful life, the reviewed useful life. So revised useful life. The revised useful life is what I want to put here now. The revised useful life as at 31 December X6. 31 December X6. At 31 December X6. This is the revised useful life. 31 December X6. 31 December X6. Sorry, what is this? Okay. At 31/12/X6. Oh, okay. It's seen that as a formula. Okay. Let me remove that. So I just put it 31 December 31/12/X6. So that's it as at this date. So it has 5-year useful life. Useful life is 5 years. Useful life. 5 years. 5 years. Sorry, this is the last example. Rounding up now. 5 years. 5 years. That's 5 years useful life. 5 years. That's useful life as at this date. So the depreciation will now be based on the kind amount as at that date at the beginning of the year divided by the useful life that it now has, which is 5 years remaining. Subsequently, the depreciation will now be 8,400. And we are going to be having that done for each year from that day. That is this amount divided by 5. And for here, this amount divided by 5. Okay, I'll just put the formula in now. Divided by 5. Let me just log the 5 in so that we have it done. Divided by 5. F3 or F4. I logged it in. So I can drag it. That's a Z function. Divided by 5. It's not dragging. Okay, divided by 5. And here also, this divided by 5. Divided by 5. And so that's going to be the depreciation charges for the year from the date when the policy was changed. That's the charge. So if this goes to statement of profit or loss, the accumulated depreciation will also be computed, and then that will be based on the balance sheet. This will be the depreciation charge henceforth, and this is the depreciation charge before that day. So what I think that the day that the policy was changed is when the depreciation will change. You will not go back and change the ones that have been before that day. Rather, you will only change the one that comes into existence after that day. That's what we call prospective application of a change in accounting estimate. Prospective application of a change in accounting estimate. So that's about that. Example 1, example 2, example 3, example 4, example 5 on the standard today. It's already past 7. We will stop here today, and tomorrow we will continue. And by the end of tomorrow, we should be able to put an end to IAS 16, because it seems to be, if not the widest standard in all the standards we want to learn for this course. So if you have question, ask now. If you think it's okay, just tell me okay, or because of our time, you may not be able to ask questions now. Go through the video again, come with your question tomorrow, and we will treat all of them together. So on both examples that we have treated. I will post the video for today here, but this note will not be there today. By tomorrow, because it needs to complete tomorrow, I'll post the comprehensive note, so that you need to pick note from it. You can pick your note from the classroom and look at them again after the class. Is anybody saying anything? Anybody saying anything? You have anything to say in the chat box, or let me try to unmute everybody. You can unmute your mic and say. If you have anything to say. You can just look at your microphone, unmute it, and say it, or you put it in the chat. Everybody, please, quickly. I want to believe you are still there. I can see you are there. I want you to respond. Dorothy is typing. Okay, you said you are okay. Dorothy said she's okay. Anybody saying anything again? Mr. Tosin, are you there? Say yes, you are okay. Mr. David, are you there? Mr. David, okay, say you are okay. Thank you very much. So I'll see you tomorrow, 5 a.m. again. We are going to be putting the final touch to this standard. You have to say bye-bye. Okay, everybody. Everybody, I'll see you tomorrow by